Let's turn our attention to the personal finance segment then. Hemant Rustagi of Wiseinvest Advisors is our expert for the day. Hemant, we've just got a new tax-free bond, the IRFC bonds, which have hit the market. So in such a scenario, what's the place of a tax-free bond that should be there in investors' portfolio, given the fact that even equities are actually doing very well? And in particular, any current issues which appear attractive to you if tax-free bonds is the way to go?
Well, I think there are currently two tax-free bonds which are on tap. The first one is HUDCO, which is rated as AA+, which has been extended now till 1st of February. And the coupon rate which has been offered for the retail investors there, and let me just clarify here, the retail investors have been defined as those investors who invest up to and including 10 lakh rupees in the bond. So the coupon rate for the retail investors for 15-year option in HUDCO is 8.01 and for the 10-year option is 7.84. IRFC is, of course, a AAA rated bond issue, and the coupon rate which is being offered to retail investor in 15-year term option is 7.84, and for the 10-year is 7.68. As far as the relevance of tax-free bonds in the portfolio is concerned, we need to really look at what exactly investors have in the debt portfolio. You see, it's usually divided into two parts. On the one hand, you have traditional investment options like PF, you have public provident fund, you have bonds, you have debentures, and you have fixed deposits. Of course, the major attraction there is one, that there is a guaranteed rate of return, and the second is the relative safety of investments. But the negative side there is that the interest which is earned, barring exceptions like PF or PPF, it's all taxable. So the real rate of return or the post-tax return is very, very low. The real rate of return, of course, is the nominal return minus inflation and minus taxes. On the other hand, you have market-linked instruments like debt funds. Since you're talking about the long-term investment options, in the current rate scenario when the interest rates are set to go down, we can look at income funds or dynamic bond funds. Because there is an inverse relationship between interest rate and the bond prices, investors can get good returns here, and the major attraction also there is that these are more tax efficient as compared to traditional. Now, when we talk about tax-free bonds, I believe that tax-free bonds offer the best of these two. One is they're quite safe in terms of as far as the investor concerns are there about safety, because these bonds are issued by the Government of India undertaking, so they're quite safe. The second is the returns are guaranteed, and returns are quite attractive too. And the fact that these returns are tax-free, I think really makes it very attractive. Now, for example, if you look at HUDCOs that we're talking about 8.01 15-year option, for a highest tax bracket investor, the pre-tax comes to around 11.6. Now, there aren't many options which will give you, this kind of return for a period of 10 to 15 years. So I believe that, tax-free bonds have to be a part of every investor's portfolio. And also another concern that investors have is of liquidity. Now, these bonds are usually listed on the one exchange or both exchanges. So liquidity is there. I wouldn't say that it's very highly liquid, but definitely I think there's a reasonable liquidity which is there. So I believe that there are definitely places for tax-free bond. Of course, the negative side there.
Hemant, that's exactly the question I had. 11-something% pre-tax is. Can you compare that with what you get, say, for a 15-year average from a debt fund, or even 10-year average for that matter? Do any of the debt funds offer that kind of a return in terms of a 10-year average, 11%?
They can at certain times. Lata, the problem is that, as I mentioned about inverse relationship, this portfolio has to be managed very, very actively. So the income fund will do well when the interest rates are going down. Now, if you do not exit after that when the interest rates
have 10-year averages. How is the 10-year? I mean, I have no idea what is the 10-year average for a debt fund. Are they still as good as this 11% pre-tax return that HUDCO gives? Or should we just blindly go to the HUDCO IRFC options if you're not even sure that over 10-15 years they give you that kind of an average, the debt funds?
Yeah, absolutely. See, even if the average is, I'm saying 9 to 10% or maybe even 10%, The fact is, like I said, not every investor can manage the portfolio very actively. Look, the returns, even if you just leave the investment in those bonds, in those income funds there, you are going to see huge variations there. So I believe that there is a scope for every kind of investment in the portfolio. It should not be only traditional option, or it should not be only income options. You can have a mix of these. So in that context, I believe that these funds, these bonds definitely have a place in the portfolio, because you are sure of what you're going to get for the next 10, 15 years. But of course, investors have to be very careful in terms of how much they allocate to these. You cannot allocate the money which you have kept aside for equities, because over a period of 15 years, equities are definitely going to.
If they are better than any other debt option, that would be a safe assumption.
I would say that. Yes.
Fair enough. We'll take a break, Hemant. We'll have viewers lined up with their questions. Markets, but let's finish off this personal finance issue which we have taken up on the tax-free bonds that are on offer. There is a viewer with a question. Zoya Ahmed is calling from Bangalore. Go ahead, Zoya.
Hello.
Yeah.
See, I had read somewhere in the newspaper which said that tax-free bonds, if sold on exchanges after they are listed, may carry a 0.5% lower interest rate. So how far is it true? And if I do buy these bonds, will I find it difficult to sell later?
Well, that's a fair question, which actually even Rima was asking me. Hemant, because you find fewer buyers, you will get a lower price?
Well, I think there is a provision here that if the original allottee who happens to be in the retail segment, as I mentioned earlier, that all those investors who invest up to and including 10 lakhs in these bonds are termed as retail investor. So if the original retail investor sells his bond in the secondary market, the subsequent buyer will get 0.5% less, which is equivalent to the rate which is being offered to HNIs and institutional and QIBs. So basically, then the rate gets equated with the other three category of investors. But of course, if the transfer happens because of death of the original holder and goes to the legal heir, then there is no change here. But yeah, definitely in that case, there is a 0.5% less. But I believe, yes, it can affect the liquidity to some extent, because the new retail buyers will not find it maybe very attractive. But the fact is that there may be demand from the institutional investors, because what we have seen the trend is that there is more inflows coming from the institutional than the retail in these bonds.
All right, Hemant, thanks so much for joining us and sharing your analysis. Just focus on